First, welcome the audience and set the premise. Many investors believe that adding more funds reduces risk, but in reality, overlapping U.S. funds often concentrate risk. Introduce the core claim. Combining total market S&P 500 and Nasdaq-heavy technology funds often leads to the same mega-cap exposure, not diversification. Preview that we will define overlap, demonstrate how to measure it, compare portfolio approaches, and give actionable steps to simplify while improving true diversification. Next, outline the agenda so viewers know what to expect. We will begin with the myth of more funds equaling safety, then explore overlap mechanics, move to examples and numbers, define true diversification through global exposure and low correlation assets, show how to audit a portfolio for overlap, present minimalist portfolio designs, test comprehension with quizzes, and wrap up with key takeaways. Now, introduce the core problem. Investors often layer U.S. total market, S&P 500, Nasdaq 100, and even dividend funds expecting diversification. However, because the top holdings overlap heavily, these portfolios behave like concentrated bets on the same mega-cap tech leaders. Emphasize that this is a false sense of safety and can amplify drawdowns if the dominant names falter. Then, define false diversification, holding multiple funds that largely contain the same securities, particularly the same top 10 mega-cap stocks. Explain that major U.S. indexes have significant overlap, sometimes exceeding a majority of their weight concentrated in similar names. Adding a dividend fund may adjust weights slightly, but does not introduce new, uncorrelated sources of return. Therefore, complexity rises without meaningful diversification benefits. Moving forward, walk through the flow. When an investor adds another U.S. equity fund, overlap with existing holdings increases. As overlap grows, the effective number of distinct bets shrinks. The portfolio then behaves like a concentrated position in the same mega-cap names, creating hidden drawdown risk. In parallel, additional funds add expense drag and rebalancing complexity, reducing net efficiency. Both paths align toward a worse risk-adjusted outcome than expected. Next, offer rough, illustrative figures to contextualize the issue. Broad U.S. total market funds often carry around 30% in the top 10 holdings, similar to the S&P 500. The Nasdaq 100 significantly concentrates in its top 10, often surpassing half of the fund. Dividend-tilted funds can still hold many of the same large-cap names. Qualitatively, the overlap of these top holdings with the S&P 500's top names is high to very high. Clarify these are approximate ranges for educational purposes and will vary by date and provider. After diagnosing the problem, define real diversification. Owning global equities beyond the U.S., incorporating bonds and real assets that behave differently, and using factor tilts intentionally. Stress that mixing low correlation assets reduces portfolio volatility and concentration. Emphasize that simpler allocations can lower fees and maintenance while improving resilience. Now visualize the contrast. In a stacked U.S. fund portfolio, a large slice represents mega-cap technology, with much smaller representation for the rest of the world. In a global balanced approach, the allocation intentionally includes international developed and emerging markets, reducing single-country and single-sector concentration. Continuing, compare two approaches. On the left, the multi-fund U.S.-centric stack is familiar and accessible, but brings heavy overlap, greater concentration, rebalancing complexity, and potentially higher all-in costs. On the right, a single Total World ETF offers one-ticker simplicity, broad global exposure, and inherently lower overlap. The trade-off may include tracking differences relative to purely domestic indices. Next, provide a step-by-step audit. First, list all funds and their expense ratios. Second, download holdings from your broker or ETF provider websites. Third, identify shared top holdings and their weights. Fourth, estimate overlap and consider calculating concentration with the Herfindahl-Hirschman index by summing squared position weights. Fifth, compare your current allocations to a total world benchmark to gauge home bias. Finally, decide which funds to consolidate to reduce overlap and simplify rebalancing. Meanwhile, provide a concise cheat sheet using Markdown. Explain that HHI is the sum of squared portfolio weights and increases as concentration rises. The effective number of bets is the reciprocal of HHI, and provides an intuitive measure of diversification. Offer a rule of thumb that high top 10 weight combined with repeated top names suggests overlap. Encourage using a single Total World ETF plus a bond sleeve unless there is a deliberate, evidence-based reason to add complexity. Subsequently, illustrate the investor journey: initial accumulation of multiple U.S. funds, realization of overlapping holdings, measurement of concentration via HHI, consolidation into a core portfolio of total world equities plus bonds, optional discipline factor tilts, and long-term maintenance through periodic rebalancing and expense checks. Now, propose model structures. The one-ticker approach uses a Total World Stock ETF for broad coverage. A 2 or 3 fund model pairs world equity with global bonds and, optionally, a cash buffer. For investors who explicitly want additional return drivers, a modest small value or quality tilt can be considered. Reinforce that the total expense ratio should remain low and rebalancing straightforward. Next, present the quiz. Read the question and options clearly. Invite the viewer to pause the video now to think about the answer. Tell them that the correct answer and explanation will be provided in the next section. Then, reveal the correct answer. Concentration risk in the same mega-cap stocks. Explain that U.S. total market, S&P 500, and Nasdaq-100 each heavily weight similar large technology names, thereby increasing concentration rather than diversifying away from it. Next, ask the second quiz question. Provide the options. Encourage the viewer to pause and consider the best answer. Mention that the explanation follows immediately. Now, give the answer, using a single Total World Stock ETF as the core. Elaborate that this reduces domestic overlap, improves global diversification, and keeps the process simple and cost-effective. Next, summarize the key points. Restate that adding funds does not ensure diversification when overlap is high, that U.S.-only stacks often orbit the same mega-cap names, that real diversification involves global exposure and low-correlation assets, and that simplicity can lower costs and friction. Encourage regular audits for overlap. Finally, provide a concise summary of actions. Identify overlap, measure concentration, compare against a global benchmark, consolidate where appropriate, maintain with periodic rebalancing and cost monitoring, and stay disciplined over time. Additionally, present a clear disclaimer. The content is educational and not financial, legal, or tax advice. Investing involves risks, including loss of principal. Viewers should conduct their own research and consider seeking advice from a qualified professional. Clarify that figures shown are illustrative and subject to change. To close, thank the audience for watching. Invite them to like, share, and subscribe. Prompt them to comment with their own experiences with overlapping funds, questions about auditing portfolios, or ideas for future topics. Encourage engagement to foster learning and community.